How should SaaS companies structure their chart of accounts? Imagine trying to understand your company's financial health without a clear map. That's what a well-organized chart of accounts can do for a SaaS business. It's the backbone of accurate financial reports and smart decision-making. SaaS companies need a chart of accounts that separates and arranges financial data in a way that makes sense for their unique revenue streams and costs. First, think of the structure starting with the balance sheet accounts. These include assets like cash, accounts receivable, which are payments owed by customers, software licenses, and equipment like computers. Liabilities cover debts such as accounts payable, taxes payable, deferred revenue, which is money received before delivering the service, and loans. Equity accounts include common stock, preferred stock, retained earnings, and additional capital contributions. Moving to the income statement, revenue accounts should be split into different streams. Subscription revenue is the main one, representing recurring monthly or yearly payments. Variable revenue depends on usage or other factors. Professional services include one-time fees for setup, consulting, or training. Other revenue might include consulting or ancillary services. Using parent and child accounts helps track each revenue source in detail but also allows for summarized reporting. When it comes to costs, separate the costs directly tied to delivering the service from operating expenses. Cost of goods sold includes cloud hosting fees, payment processing costs, customer support tools, and salaries for engineers or customer success teams involved in service delivery. Operating expenses cover marketing, sales commissions, development tools, general administrative costs, and office software. Breaking expenses down by department like marketing, sales, engineering, or administration helps see where resources go and supports budgeting. A coding system that tags expenses and revenues by department or cost center makes internal analysis easier. This way, you can identify which teams contribute most to revenue or incur the highest costs. Keep your account names and numbers consistent and clear. Use a logical numbering system so it's easy to find and compare data across periods. Avoid deleting old accounts. Instead, mark them as inactive to keep historical data intact. Regularly review and update your chart of accounts as your business grows or reporting needs change. For early-stage SaaS companies, focus on broad categories that investors want to see. As your company matures, add more detailed accounts to support operational decisions and compliance. Larger SaaS firms often implement full cost center accounting to track expenses and revenues at a very detailed level. In the end, a well-structured chart of accounts balances detailed operational data with the ability to produce clear financial reports. It helps you stay organized, prepare for audits, and calculate key SaaS metrics like monthly recurring revenue or customer lifetime value. Using parent-child accounts, departmental coding, and separating revenue streams and costs by function creates a strong financial foundation tailored to your SaaS business.